You're sitting at your desk right now. You just checked your bank account, $22,347. And for the first time in your life, you're not stressed about money. You're confused because nothing feels different. You're still going to the same job, still driving the same car, still eating the same lunch. But something is different. You just don't know what yet. That confusion is important. Most big moments in life announce themselves loudly. Graduation, a breakup, a promotion, a move. There's usually a clear emotional signal that tells you something has changed. This moment doesn't do that. It slips by quietly, almost invisibly. And because nothing external shifts, your brain assumes nothing internal has either. But that assumption is wrong. Let me tell you which just happened. You crossed a threshold that 76% of Americans will never cross. And I'm not talking about being rich. I'm talking about the exact moment where the rules of money completely change, where your brain rewires, where the math starts working for you instead of against you. That number is $20,000. And if you just hit it, or you're close, or you're wondering what the hell happens next, everything I'm about to show you will change your financial life permanently. What makes this moment dangerous is that nobody warns you it's happening. There's no alert, no celebration, no signal telling you to shift gears. So most people don't. They keep driving with the same habits, the same instincts, the same mental rules they used when they were broke, and that's how they stall out. Here's what nobody tells you. The median American has $8,000 saved. Half the country has less than that. According to the Federal Reserve's 2022 Survey of Consumer Finances, that's the median transaction account balance in America, $8,000. You're at 20. You're not in the top 1%, but you're in the top 25%. You're in rarefied air and you don't even know it yet. That gap matters because the experience of money at $8,000 and the experience of money at $20,000 are not the same, even if the lifestyle looks identical from the outside. At $8,000, you're one problem away from panic. At $20,000, you're one problem away from inconvenience. That difference alone changes how your nervous system operates. But here's the problem. You hit $20,000 and your brain does something stupid. It whispers, you deserve to celebrate. You've been grinding for 3 years. Book that trip to Europe, upgrade your car, move to a nicer place. You earned this. And that voice will destroy everything you just built. Because $20,000 isn't the finish line, it's the starting gun. That voice doesn't sound reckless. It sounds reasonable. It sounds like self-care. It sounds like fairness. And that's why it's so dangerous. Most people don't sabotage themselves with one big mistake. They do it by relaxing too early. They confuse relief with arrival. I'm going to show you 3 things in the next 25 minutes. First, the exact psychological rewiring that happens in your brain at $20,000 that separates people who build wealth from people who stay broke forever. Second, the mathematical reality of what $20,000 becomes when you deploy it correctly versus when you let it sit. And third, the precise action plan, not theory, not motivation, actual steps to turn $20,000 into $200,000, then $500,000, then 7 figures, with real numbers, real timelines, real math. Let's go. You know what happened yesterday? You bought a coffee, $6.50. Didn't think about it, tapped your card, walked out. 2 years ago, when you had $3,000 saved, that $6.50 coffee was a debate. Do I really need this? I could make coffee at home. That's $6.50 I could save. You felt the weight of every dollar. But yesterday, no debate. You bought the coffee. You didn't check your account first. Why? Because you have $20,000. Your brain stopped treating every purchase like a survival decision. That moment seems small, but it's not. It's one of the clearest signals that your internal relationship with money has shifted. When money is scarce, every decision feels loaded. Every swipe feels like it might have consequences you can't recover from. When you cross a buffer large enough to absorb mistakes, your brain finally relaxes. This is called loss aversion reversal, and it's one of 3 psychological shifts that happen at exactly this threshold. Psychologists Daniel Kahneman and Amos Tversky won a Nobel Prize proving that humans feel losses 2.5 times more intensely than equivalent gains. When you had $2,000 saved and you lost $100, it felt like getting punched. Your heart rate went up, you stressed for days, you thought about what you could have done differently. But now you have $20,000 and you spend $100 on something unexpected. You barely notice. Your brain shifted from scarcity to abundance mode, from defense to offense. This shift isn't about becoming careless, it's about your nervous system recalibrating risk. At lower balances, your brain treats small losses as existential threats. At higher balances, it finally has room to think in probabilities instead of emergencies. Here's why this matters. During the COVID-19 market crash in March 2020, retail investors with account balances above $15,000 were 47% less likely to panic sell than investors with balances under $5,000. Almost half. Same market, same crash. Different psychology. The people with bigger buffers made rational decisions. The people with smaller buffers made emotional decisions. And emotional decisions in finance cost you decades. That's the first shift. Second shift, your brain starts creating multiple mental accounts automatically. Richard Thaler won a Nobel Prize for discovering this. When you have $5,000 saved, all of it is emergency money. It's one bucket, one purpose, defensive. But something happens around $20,000. You start thinking, okay, $6,000 is my real emergency fund. $7,000 is going into my Roth IRA. $7,000 is going into investments. You're not thinking about one pile of money anymore. You're thinking about allocation, strategy, deployment. Your brain graduated from survival mode to wealth building mode. This is subtle but powerful. Allocation thinking forces you to consider trade-offs. It introduces intention. Instead of asking, can I afford this? You start asking, which bucket does this come from? That single question prevents thousands of bad decisions over a lifetime. Third shift, the visibility threshold. According to Vanguard's 2024 How America Saves report, the median 401k balance for people in their 20s is $11,000. For people in their 30s, it jumps to $38,000. But here's what that doesn't tell you. The jump happens mentally before it happens financially. When you hit $20,000, you can see a path to $100,000. It's not abstract. You run the math. I saved $10,000 this year. If I do that again, that's $30,000 next year. If I increase my rate, that's $50,000 in 3 years. Holy shit, I could hit 6 figures in 5 years. That future becomes real, visible, tangible. And when you can see your financial future clearly, your behavior changes permanently. This is the point where hope turns into expectation, and expectation is what drives consistency. People don't stick with plans they don't believe will work. At $20,000, the plan stops being theoretical. Here's the data that proves this. The Bureau of Economic Analysis reports that Americans save about 4.9% of their income on average, but when you break it down by account balance, the pattern is insane. People with under $5,000 saved have a 2 to 3% savings rate. People with $5,000 to $15,000 saved have a 5 to 7% savings rate. People with $15,000 to $30,000 saved have a 9 to 12% savings rate. Your savings rate doubles once you cross this threshold, not because you suddenly make more money, because you proved to yourself you can do it, and your brain locks in that identity. Now, here's the question you're asking. Why $20,000? Why not $10,000? Why not $50,000? At $10,000, you're vulnerable. The Federal Reserve found that 56% of Americans can't cover a $1,000 emergency from savings. At $10,000, you're above that. You can handle emergencies, but you're one major crisis away from restarting. Car transmission, $4,000. Medical emergency after insurance, $3,000. Laptop dies and you need it for work, $1,500. Suddenly, you're at $1,500 and the psychological damage is catastrophic. You're back in scarcity mode. At $50,000, you've already won. You don't need this video. You figured it out. Compound interest is visibly working for you. But $20,000 is the Goldilocks zone. You have enough that a $3,000 emergency doesn't destroy you. You drop to $17,000 and you're psychologically intact. You rebuild in 4 to 6 months, but you don't have so much that you get complacent. You're still hungry, still building, still in the danger zone where one stupid decision could derail you. Let me show you what stupid looks like.
So you hit $20,000. You celebrate by spending $4,000 on a vacation. You're at $16,000. You rebuild over 8 months back to $21,000. Your car needs $2,500 in work. You're at $18,500. You rebuild to $23,000 over 10 months. You upgrade your apartment. First, last, security, moving costs, $5,000. You're back to $18,000. 3 years later, you've been bouncing between $16,000 and $23,000, never breaking through. You're on a treadmill, and every time you drop below $20,000, you lose the psychological momentum. The visibility threshold disappears. You start thinking, maybe I'm not actually good at money. Maybe I just got lucky. That self-doubt is what keeps people trapped. Not lack of income, not lack of intelligence, a broken feedback loop. According to a study in the Journal of Consumer Research, people who receive unexpected windfalls, bonuses, tax refunds, and inheritances spend 70 to 80% within 3 months. But people who build wealth slowly through systematic saving, they spend less than 5% when they hit milestones. The difference is psychological ownership. You grind for 3 years to build $20,000. Your brain treats it as sacred. You protect it differently. Here's the framework that prevents you from destroying your momentum: the 90-10 rule. When you hit a financial milestone, you celebrate with 10% of the gain, not the total. You hit $20,000 from zero, that's a $20,000 gain. 10% is $2,000. You spend $200 on celebration. Nice dinner, maybe a weekend trip. Something memorable but not destructive. You keep $19,800 working. You keep 90% of your momentum. You keep the psychological victory intact. That distinction matters because your brain doesn't just track numbers, it tracks meaning. When you celebrate correctly, you're telling yourself, I can enjoy progress without sabotaging it. When you celebrate incorrectly, you teach yourself that success leads to loss. Over time, that creates hesitation. People unconsciously avoid winning because winning has historically meant giving it all back. Now let's talk about what actually happens to that $20,000, because this is where most people completely screw up, not out of recklessness, but out of caution. They keep all $20,000 in savings earning 4.5%, and they think they're being smart. It's safe, it's liquid, I can access it if I need it. Wrong, dead wrong, because inflation is eating roughly 3% of that every year. Your real return is closer to 1.5%. You're barely keeping pace. You're not building wealth. You're standing still and calling it progress. Standing still feels responsible when you've spent most of your life scrambling, but at this stage, safety without structure becomes stagnation. Money that isn't assigned a job will eventually wander off. Here's what you should do instead. You split that $20,000 into 3 buckets the moment you cross the threshold. Bucket 1, emergency fund. This is your insurance policy. 3 to 6 months of essential expenses, not your total spending, your essentials. Rent, utilities, minimum food, insurance, transportation that keeps you employed. For most people making $50,000 to $60,000, this comes out to about $2,000 to $2,500 per month in essentials. Multiply that by 4 months and you're looking at $8,000 to $10,000. Let's say $8,000. This stays in high-yield savings, boring, liquid, untouched. Its job is not to grow. Its job is to keep you out of debt when life happens. Bucket 2, tax-advantaged growth. This is your Roth IRA. In 2025, you can contribute up to $7,000 per year if you're under 50. This bucket has superpowers. Everything it earns grows tax-free forever. You put in $7,000 today, in 30 years at an 8% average annual return, that $7,000 becomes $70,380. If that same growth happened in a regular account, you'd owe taxes on the $63,380. At a 24% tax rate, that's over $15,000 gone. In a Roth IRA, zero. That's not a loophole, that's the rule. Bucket 3, taxable investments. This is your flexibility fund. Same investments, low-cost index funds like VTI or VTSAX, but without restrictions. Down payment in 6 years? This bucket. Starting a business in 4 years? This bucket. Life decisions that don't fit neatly into retirement timelines? This bucket. Emergency fund is for emergencies. Roth IRA is for retirement. Taxable brokerage is for life. So here's what your $20,000 looks like properly deployed. $8,000 in high-yield savings as your emergency fund. $7,000 in a Roth IRA invested in a total market index fund. $5,000 in a taxable brokerage invested the same way. Now you keep saving, let's say $600 per month. Where does it go? At first, $200 per month goes to rebuilding your emergency fund from $8,000 to $10,000. That takes 10 months. The other $400 per month goes straight into your taxable brokerage. After those 10 months, your emergency fund is locked in at $10,000. From that point forward, all $600 per month goes to investments. You split it 60-40. $360 per month towards next year's Roth IRA, $240 per month into taxable investments. This isn't theory, this is execution. Let me show you what happens. After 10 months, your emergency fund is fully funded. Your Roth IRA has grown slightly. Your taxable account has accumulated contributions and modest gains. You haven't felt deprived. You haven't changed your lifestyle. You've just been consistent. After 22 months, just under 2 years, your numbers look like this. Emergency fund, $10,000. Roth IRA, roughly $15,500. Taxable brokerage, about $13,200. Total net worth, $38,700. You started with $20,000. You nearly doubled it in under 2 years. And this is still the slow part of the curve. What matters more than the number is what happened psychologically. You didn't just save money, you ran a system. You watched money move automatically. You experienced growth without stress. That changes how you think permanently. Now let me show you what this looks like in real life. It's Tuesday morning, you're at work. Your manager sends you a message, "Can we talk?" Your stomach tightens out of habit. You walk into her office, she offers you a new project, more responsibility, more visibility, but no immediate raise. We'll revisit compensation in 6 months. Old you, with $3,000 saved, would have said yes immediately, no hesitation. You couldn't afford to rock the boat. You needed stability more than fairness. You, with $20,000 properly deployed, respond differently, calmly, professionally. I'm excited about the project. Given the additional scope, I'd like to talk about compensation now rather than later. What's the budget for this role? You didn't become aggressive, you became grounded. You had leverage, not because you were rich, but because you weren't desperate. It's Friday night, your friends text you. Vegas this weekend? Flights are $300. Hotel split 4 ways is $200. Figure $500 for the weekend. You in? Old you checks your account. You have $4,200. That trip is nearly a quarter of everything you own. You feel sick thinking about it. You make up an excuse. You stay home. Relief mixed with resentment. You, with $20,000, see the same numbers differently. The trip might still not align with your goals. You might still say no, but now it's a strategic no, not a fear-based one. You're choosing. That distinction matters more than the decision itself. It's Sunday brunch. A friend talks about buying a condo. I've got $30,000 saved. Should I do it? Old you listens quietly. You don't feel qualified to contribute. You, with $20,000 and a system, ask better questions. What does your emergency fund look like after the down payment? How stable is your income? Are you okay if the market dips? You're not giving advice, you're thinking structurally. That's new. It's Monday, your check engine light comes on. The mechanic tells you it's the transmission, $4,200. Old you panics, credit cards, family calls, sleepless nights. You, with $20,000, sigh. You pay it, you drop to $15,800. It hurts, but it doesn't break you. You run the math, you'll rebuild in 7 months, maybe 6 if you tighten up temporarily. No debt, no drama. That's what $20,000 actually buys you. Not luxury, not status, stability of response. Now here's where it gets interesting. Let's assume you increase your savings by just $100 per month every year, not through extreme discipline, through raises, skill growth, or cutting one expense. Year 1, you save $600 per month. Year 2, $700 per month. Year 3, $800 per month. By year 5, you're at $1,000 per month. By year 10, $1,500 per month. Starting from $20,000 and earning 8% annually, here's what that looks like. Year 5, around $71,000. Year 10, about $186,000. Year 15, around $378,000. Year 20, nearly $700,000. No lottery, no crypto moonshot, just math and time. Most people never reach this point because they make one mistake. They treat $20,000 like the destination. They relax, they slow down, they cut their savings in half because they're good now. 3 years later, they're at $32,000 instead of $47,000. They lost tens of thousands.
Now, there is no enough until your investments can support your life. For most people, that's somewhere between $1 and $2 million. Until then, $20,000 isn't security, it's proof of capability. And that proof changes how fast you move. This is where lifestyle inflation arbitrage comes in. Most people get raises and spend them entirely. Income up, lifestyle up, savings flat. You do something different. Income goes up $10,000, lifestyle goes up $5,000, savings go up $5,000. You enjoy progress without erasing it. Meet Alex, 28 years old, makes $55,000, just hit $20,000 saved, saves $600 per month. At 30, Alex switches jobs and jumps to $65,000. Most people keep saving $600. Alex increases to $1,000. Lifestyle improves, but so does trajectory. At 33, Alex earns $75,000. Savings jump to $1,500 per month. At 36, Alex hits $88,000 and saves over $2,000 per month.
At 38, Alex has over $300,000 invested. Same decade, same economy, different behavior. That's not luck, that's execution. Now, here's the question you're really asking, even if you haven't said it out loud yet. How do I actually stay consistent for 10, 20, 30 years? Because the math works, the plan works, the structure works, but none of it matters if you stop executing once the novelty wears off. And this is where most people fail. Not because they don't understand money, because they misunderstand themselves. Here's what actually works. You don't rely on motivation. You rely on identity and systems. Identity comes first. When you hit $20,000, you are no longer someone trying to get their finances together. That phase is over. You are an investor. You are a wealth builder. You are someone who deploys capital. This isn't motivational fluff. This is behavioral psychology. Your actions follow the story you tell yourself about who you are. If you still see yourself as broke, you will make broke decisions even with money in the bank. If you see yourself as a wealth builder, you'll make disciplined decisions even when things get tight. When $2,000 hits your account, broke identity thinks, I should save some of this. Wealth builder identity thinks, this is capital. It asks different questions. Where does this go? What role does it serve? How does this move the plan forward? Same income, same money, completely different outcomes. Systems come second. You automate everything, so willpower is irrelevant. Money moves the day after payday. You don't decide whether to invest this month. The system decides. Your job is just to not interfere. Every system you don't automate becomes a future failure point. Every decision you leave manual becomes a moment where emotion can creep in. And then there's the third piece almost nobody talks about. You need a forcing function, something that keeps you honest without making you obsessive. That's where quarterly reviews come in. Once every 3 months, you sit down for 90 minutes. You check your net worth, you check your savings rate, you check if your plan still makes sense. You make adjustments if needed, and then you stop thinking about it. No daily app checking, no doom scrolling market news, no emotional whiplash. Quarterly reviews give you accountability without anxiety. Now, let me tell you what to expect emotionally, because knowing what's coming is how you avoid quitting when things feel wrong. Months 1 to 3 after hitting $20,000 feel incredible. You're energized, you're checking your accounts constantly, you're doing the math in your head, you're imagining future versions of your life. Everything feels possible. The danger here is overconfidence. This is when people chase shiny investments or inflate their lifestyle too fast. The protection is simple. Stick to the system. Don't let excitement change the plan. Months 4 to 9 feel very different. The excitement fades, reality sets in. You realize $20,000 isn't actually that much. You start comparing yourself to people further ahead. Market fluctuations suddenly feel personal. Anxiety creeps in. This phase is normal. Everyone who builds wealth goes through it. Anxiety doesn't mean you're doing something wrong. It means you finally understand the stakes. The key is to keep executing anyway. Months 10 to 18 are the hardest. This is the grind. Nothing dramatic is happening. You're saving, you're investing, the numbers are moving, but slowly. It feels boring, it feels repetitive. Some days it feels pointless. This is where most people quit. They don't blow up their finances, they just stop paying attention. They loosen discipline, they drift. But here's the truth. Boring is what wealth feels like while it's being built. Excitement is usually a warning sign. Months 19 to 36 are where confidence sets in. You've been through a market dip and didn't panic. You've had unexpected expenses and didn't derail. You've increased your savings rate and realized it didn't hurt as much as you feared. This is where momentum becomes self-sustaining. This is where the plan stops feeling fragile. Most people never reach this phase because they quit during the grind. Confidence is always on the other side of boredom. Now, here's the concept that quietly changes everything. The real power of $20,000 isn't what it earns, it's what it does to your income. When you have no buffer, every career decision is made from fear. You take the offer, you accept the terms, you stay longer than you should because leaving feels risky. With $20,000, that changes. You negotiate differently, you interview better, you're willing to walk away from bad deals. You can afford to wait for the right move instead of grabbing the first one that feels safe. There's research showing that people with higher savings have lower cortisol responses to financial stress. Lower cortisol means clearer thinking. Clearer thinking leads to better decisions. Better decisions compound into better outcomes. Money doesn't just grow at 8% in your account, it grows in how you show up to your life. The average raise from staying at one company is about 3 to 4%. The average increase from switching companies strategically is 10 to 20%. You do that a couple of times early in your career, and your entire trajectory changes. But you can only take those risks if you have runway. Two people can start at the same salary and end up worlds apart, not because one was smarter, but because one had leverage earlier. Once you're in that flywheel, confidence leading to better decisions leading to higher income leading to more savings, it's hard to stop. The system feeds itself. But entering the flywheel requires one thing: getting past the survival phase, and $20,000 is the entry point. Here's what's going to happen socially. People will say you're lucky. They'll say money isn't everything. They'll say you should enjoy life. What they're really doing is trying to make your choices feel less valid because different choices make people uncomfortable. You'll look boring before you look right. Be boring, because 10 years from now, boring looks like options. Let me give you a lens that changes how you see every purchase: opportunity cost. At 8% returns, every dollar you spend today could have been $10 in 30 years. That $6 coffee isn't $6, it's $60 of future wealth. That $150 dinner is $1,500 in future money. That $10,000 upgrade is 6 figures you don't get later. This doesn't mean never spend. It means choose consciously. Some moments are absolutely worth the trade. Most are not. Before big purchases, ask yourself one question: is this worth what it costs my future self? Now here's the most important reassurance. You're going to have setbacks. The market will crash at some point. You will have unexpected expenses. Something will knock you back. And it doesn't matter, because once you've built $20,000 once, you've proven the skill, and skills don't disappear. If you ever fall back to $8,000, you won't be starting from zero. You'll be starting from experience. People who rebuild after financial setbacks return to their previous savings levels much faster the second time. The pathways are already built. That's why the first $20,000 is brutal. The second is easier. The third feels almost automatic. So here's the challenge. Within 48 hours, do one thing. Not everything, one thing. Open the account, set the transfer, make a single move that turns understanding into action. Information without action is just entertainment. It feels productive, but it doesn't change anything. Opening a Roth IRA takes 15 minutes. People avoid it for 15 years. Setting up automation takes 5 minutes. People delay it for 5 years. Why? Because action creates commitment, and commitment means the possibility of failure. But here's what's scarier than failing: reaching 65, still working, still stressed, knowing you understood the path decades earlier and didn't take it. You're here because part of you wants more security, more freedom, more control. That part of you is right. $20,000 is where that desire stops being abstract and starts being real. Everything changes after $20,000, but only if you change with it. That's how you win, quietly. And once you see it, you can't unsee it.